All right, the final chapter on mortgages. So there's three chapters, chapter 13, 14, and this is chapter 15, financing two, primary and secondary markets. Hmm. What is the primary market? You should already know this because some of these things already overlap. What's the primary mortgage market? That's where loans are originated to the consumer to buy real estate. And the secondary market is where those loans are then resold to investors. So, at the end of this chapter, you're going to be able to describe various financing techniques, identify sources of real estate financing in the primary mortgage market, and explain government influences on mortgage lending. So, how do banks get their money? In a nutshell, how does lending work? Well, banks lend their depositors money, even though we saw that money as debt video that shows technically that's not true. They just conjure it up out of thin air. So banks lend their depositors money with the intent of reselling those loans to get the money back, plus interest, plus a servicing fee for the collections. Most lenders are not portfolio lenders. Those are lenders that lend their own money and generally don't resell the loans. They keep them within their own investment portfolio, thus the name portfolio lender, or some people may call them conventional lenders. Um, loans that are originated in loans are originated in the primary market or primary mortgage market directly to consumers to buy real estate. And then those loans are resold to investors in what is deemed the secondary market. So the primary market lenders, the sources of borrowing money from, are typically mortgage bankers, mortgage brokers, and credit unions. Anyone know the difference between a mortgage banker and a mortgage broker? Mortgage bankers work for one bank, and therefore they usually only could originate funds from that one lender. Mortgage bank brokers, however, they are independent. They work with many different lenders, many different banks, many different investors, etc. And then we have credit unions. Credit unions, these are nonprofit banks. Fannie Mae is the largest purchaser of loans in the secondary market, and it's estimated that they buy one out of every 10 loans originated in existence today. Ginnie Mae, that's Fannie's ugly stepsister. I like to call her that because I'm mean. No, 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 it's not because of that reason. Ginnie Mae is Fannie's ugly stepsister because she buys those riskier loans, the ones from people with less than perfect credit. They may not be performing very well. So Ginnie Mae buys those uglier, those riskier loans. And then Freddie Mac, well, they buy loans from portfolio lenders, those conventional loans where they were not originated according to some third party investors' guidelines for the types of loans they're willing to buy. But sometimes portfolio lenders do need to liquidate their assets to get money for a new investment. And if that's the case, who's going to buy those loans because they were never originated according to some third parties' lending guidelines for the loans they're willing to buy? So Freddie Mac will purchase them. They'll analyze it on an individual basis and they'll purchase those loans. So here are some of the lenders in the primary mortgage market. We have institutional lenders. Well, let's see. Lenders loan money to purchase real estate as an investment. In exchange, they earn interest. And institutional lending, we have savings and loan associations. Those are the banks. We have commercial lenders, which are private investors, insurance companies, which are private investors, mortgage brokers, they deal with many lenders, credit unions, those nonprofit banks, and we have pension and trust funds. They also invest those retirement plan money of people trying to build it up, and they're considered a private investor. So let's highlight the primary mortgage market. Lenders supply funds to borrowers.
Got it.
This is the way credit works. I put together this slide for you guys, give you an overview of how it works. You may have seen these things disjointed in different chapters here, or you'll probably even see them all in this chapter, but a little bit not explained as well. So pre-qualification letter, that's where you start out with. When you guys have a client that are looking to buy a house, we want to make sure they're pre-qualified for a loan. It's the minimum that we could do. Basically, we hook them up with a mortgage solicitor, and they run their credit score, and they tell them how much money they make and what their approximate long-term debts are. And based on this initial data, they run some numbers and they say, well, if all this information is correct, then you could qualify for a loan of up to this amount. And that's what a mortgage pre-qualification letter does. So far, all that information has been unverified except for the credit report. Then they start working towards getting a loan pre-approval letter by providing their pay stubs and bank statements and tax returns to then provide evidence of their income and assets. And then a mortgage pre-approval letter is then supplied to them. And that's much better than a pre-qualification letter because all that information now is verified. So it gives us a little bit more of a leg to stand on when we're trying to negotiate in a multiple offer situation. Hey, our purchase contract is accompanied by a pre-approval letter. The buyer is approved for this loan. You know that they could get it. Now it's just a matter of if the house will get approved. In other words, that it appraises for the purchase price and there's no major issues with the structure and the house. It's not getting eaten up by termites, and there's no it appraises for the purchase price, and there's no dangerous conditions present. Otherwise, the buyer can get the loan to purchase this house. Whereas if you have other offers on the house, they may not be accompanied by a pre-approval letter, so you don't know if they could even get the loan. So doesn't that make our offer sound a lot better right now? Doesn't matter how much the other one is. You could have other offers that are higher. You don't know if they could get it. With my client and their pre-approval letter, they're approved already with the lender, so that they could get the loan. Now, through the process known as underwriting, we call this risk-based lending. So a person called an underwriter works at a bank, and their job is to analyze risk. They make sure all the documents are provided and all the information is accurate, and then they try to analyze the risk to the lender through the process known as underwriting. So they carefully investigate the applicant's financial information and information about the property to determine if they're going to grant the loan. So the lender examines all the buyer's information, their approval and borrower process here includes their finances, their income and expenses, and they analyze their debt to income ratio, and they verify assets and credit history to determine the risk to the lender. They examine the property information then afterwards to make sure the property is approved for the loan. They want to see an appraisal. That's an estimate of value, but by an independent, unbiased third party, which we call an appraiser. Then at minimum, they're going to want a copy of a wood-destroying insect report. Make sure the structure is not being eaten up by termites. And a certificate of occupancy or fire inspection report, if they're required by the municipality, which most municipalities do require. And then a loan commitment is issued, a commitment letter from the lender when they're committing to giving the loan to the borrower to purchase this particular property. So this is a date that we actually put in contracts when the borrower needs to supply the commitment letter to the seller by. So a commitment letter is issued after the borrower completes the loan application. They submit their financial information. That information is verified. Property appraisal and inspection report is also submitted to the lender. If the underwriter decides they're going to grant the loan, they issue a commitment letter committing the lender to giving the borrower the loan. So commitment letter is that final stage. Well, before they finally actually give the money. This is the best the book's got on that. This is how the book explains it. So you got to do these highlights.
Got it.
All right. When they run your credit to get a loan to buy a house, they run your credit with the three major credit reporting agencies, Experian, Equifax, and TransUnion. Now, a lot of people think it's some kind of big scientific mathematical formula to figure out and calculate what your credit score is, maybe by averaging out the three credit report numbers. They don't do none of that. They just take the one in the middle, and that's your credit score. Now, qualifying ratios, we need to know what these are for exams. Example of a qualifying ratio is a DTI, a debt to income ratio. It's used to determine the maximum monthly expense for housing that a borrower could afford to pay. And that is PITI. PITI is your maximum monthly expense for housing. It's the principal and interest, that's your loan, plus the taxes and insurance. And of course, if you're getting a condo, they also need to factor in that monthly fee as well. Now, an example of a qualifying ratio could be 28-36. 28% would be the monthly income for housing expense, and 36 would calculate the income of all the long-term debts. Sometimes lenders would allow up to 48% or more, depending on the lender. Now, here's that home buyer's guide from the Department of Banking and Insurance, the Real Estate Commission and Department of Banking and Insurance that I shared with you guys once before. The coming slides are going to have some screenshots from that talking about the how to shop for a loan and loan affordability and understanding how lending works. So they'll have the screenshot here that explains this a little bit better. But I want you to highlight qualifying ratios on page 287, and I want you to write next to it, an example of a qualifying ratio is a DTI, debt to income ratio. You're going to need about 3 lines of text for this. An example of a qualifying ratio is a DTI, debt to income ratio, used to determine the maximum monthly expense for housing a borrower could afford to pay. PITI. I want you to write all that next to qualifying ratios there in the book. Let me know when everybody has that.
Got it.
Anybody still writing, or does everybody have it?
I have it.
Okay.
Got it.
So here's a screenshot from that home buyer's guide explaining what a debt to income ratio is. It does a little better job than the book. The debt to income ratio, the DTI, is one of the first factors a lender may consider when deciding how large of a mortgage loan you qualify for. They first got to calculate your debt to income ratio to figure out what the maximum monthly payment you could afford to make is. And then based on that, they could tell you how much you could afford to borrow. Okay, so to calculate your DTI, you got to add up your current monthly debt, your credit card payments, car loans, etc., and then divide it by your total monthly pre-tax dollars, your gross income. This percentage ratio is a simple way of showing how much of your income is available to make a mortgage loan payment after all other continuing debt obligations are met. Lenders often call this the 28-36 qualifying ratio. The first number, 28%, indicates the maximum amount of your monthly pre-tax gross income that the lender allows for monthly housing expense. This amount will include your principal and interest of the loan, your property taxes and homeowners insurance, or PT or PITI, principal, interest, taxes, and insurance. The second number, 36, refers to the maximum percentage of your monthly pre-tax gross income that the lender allows for all monthly housing expenses plus all reoccurring debt. Because they don't want you using all of your money on the house, because you know you're going to have heating bills, right? Electric bills, cable TV bills, internet, food bills, and car insurance and gas and all kinds of other clothing expenses, entertainment. We know that you're going to have other expenses in life to get by. So you should not be maxing yourself out simply on your housing. So you can get this from that link here, the Home Buyer's Guide. Excuse me. If you wanted, I could send it to you again, the link. I'll put it to everybody in the chat window. Now, if your ratio numbers are higher than 28-36, you may want to consider reducing your debt by paying off some credit cards or other loans before starting your home search. When calculating and relying on your DTI to determine loan affordability, be confident with your numbers and don't be afraid to stick with them. In other words, don't go overextending yourself. Some lenders may allow you to. They may allow higher ratios and be willing to loan you amounts that will take you beyond the traditional qualifying ratio that you can afford. This could lead to more costly monthly payments and might cause financial hardships if you find your loan is not affordable once you have moved into your new home. And you don't really want to overextend yourself that way. Then every year you're going to be, or every month you're going to be struggling just to pay your bills. All right, government influence on mortgage lending. If you guys recall, I told you that the Federal Reserve, or the Fed, sounds like it's official, but they're not actually a part of the government at all. Their job is to try to counter inflationary and deflationary trends to establish economic stability and maintain fair credit conditions, sound credit conditions by altering the applicable federal rate, the AFR, which all lending is based on. The Fed is the central bank in the United States here, and their job is to raise the interest rates as much as possible for for their member banks, while trying not to destroy the economy in the process. So it's a delicate balancing act for them to be lowering and raising those interest rates. because they could be detrimental to our economy if they raise them too quickly. That's why you see, current President Trump arguing with that Fed Reserve guy, Powell, trying to get him to lower those rates. And now he got him to finally lower them, but he only lowered them a smidgen instead of lowering them much more. And then he said, "Well, we're going to be lowering them 3 more times before the end of the year." Okay, well, why not just do it now? You did that under Biden. See, the argument now is that it's going to be a political football, because he's got some people in his cabinet or that are left over. Well, this guy's not in his cabinet. He's part of the Federal Reserve, and they say they play, political games, depending on who's in office. They did multiple drops of the interest rates under President Biden. But now he's fighting Trump every step of the way, trying to get when he's trying to get him to lower the rates, so that they gets if you're going to raise rates, you gotta do them in steps as the economy's flourishing. You can't raise them too quickly, otherwise it could be like a kneecapping somebody, before they had a chance to totally get up back on their legs. So the Fed is not a part of the federal government. It's a central bank created by Congress in 1913 to establish economic stability, setting rates, creating new money, and fractional lending. The AFR is the applicable federal rate. You don't need to write any of this down, by the way. I'm just explaining it to you. Okay. We went over that documentary, Money is Debt, or at least a couple minutes of it. Did anybody watch the rest of it? No. It's an interesting video to watch the rest of it. I mean, you guys seem to have thought it was interesting while we were watching the first 15 to 17 minutes of it, I believe.
I pinned it so I can come back to it later.
Yeah, check it out though. Do check it out. It is an interesting thing, the way they explain it in a simple way that all of us could understand it without being financial gurus. So once again, the primary market, that's where lenders loan money to consumers to buy real estate, and lenders who originate loans for the purpose of selling them to investors, that's the secondary market. So Fannie Mae is the largest purchaser of loans in the secondary market. So she has a lot of influence in setting the lending criteria, because your local bank will write loans according to these third-party lenders' criteria for the loans they're willing to buy. And if Fannie Mae is the largest purchaser of loans in the secondary market, when Fannie Mae changes the criteria for the types of loans that they're willing to buy, your local lender also usually changes their lending criteria to match those of Fannie Mae. Think they have a little influence there? So Fannie Mae, her stock symbol is FNMA because she used to be called the Federal National Mortgage Association. So FNMA. Now you could also sound it out. Fannie Mae, FNMA, FNMA. See that? FNMA. And they're a shareholder-owned company operating under congressional charter. Yeah, the United States Congress. That's what congressional charter is. So they're the largest purchaser of loans in the secondary market. Yeah, after all those government bailouts we did, remember the banks were all too big to fail? We, the people, now pretty much own Fannie Mae. We're trying to get them off our books so that they can manage themselves. So we got to get them in shape to do so. So they purchase 1 out of every 10 loans, making them very influential. When they change their criteria for the loans they're going to buy, your banks change their criteria to match. And loans that meet Fannie Mae's lending guidelines are called conforming loans because they conform to Fannie Mae's lending standards. Not to be confused with conventional loans, which don't conform to anybody's standards, because those come from portfolio lenders who lend their own money. they make their own decisions on who they're going to lend to. Ginnie Mae, that's Fannie's ugly stepsister, if you recall. You could sound that out too. Her stock symbol is GNMA, formerly called the Government National Mortgage Association. Ginnie Mae. See how I sound that out? I don't know why, but often you may get a question on state exam asking which one of these loans or which of these loans are related. Well, you could see Fannie Mae and Ginnie Mae share the same last name, but they may also throw in there Freddie Mac and Sallie Mae. Sallie Mae has nothing to do with real estate mortgages. Sallie Mae is a purchaser of student loans. Remember Sallie Mae? So,
Hey,
yeah. So just know that Sallie Mae is not the one you should select as being related to doing the purchasing of loans, real estate loans in the secondary market. And then lastly, we got Freddie Mac. You're not sounding out their stock symbol. Freddie Mac is FHLMC and also bears a male's name, Freddie, instead of Ginny or Fanny, Freddie. So two females and a male there. So Freddie, think of him. He's rebellious. He doesn't want to conform to anybody's standards. So Freddie Mac, those loans are originated by portfolio lenders or conventional lenders that they don't conform to anybody's lending guidelines because they want to stand on their own. They lend their own money. They're going to make the final decision on who they lend to. So I guess loans that meet Fannie Mae's guidelines are called conforming loans. Let's highlight that on page 288. Loans that meet Fannie Mae's lending guidelines are called conforming loans. But I just keep telling you this thing about Ginny being Fanny's ugly stepsister just so that you know they're related. Because they ask you some kind of stupid question on exam about the relation of them.
Got it.
All right, so if loans that meet Fannie Mae's lending guidelines are called conforming loans, what do we call loans that do not meet Fannie Mae's lending guidelines? They're non-conforming loans. They do not conform to their lending standards. So these are loans they're not willing to buy. Those are called conforming loans. So who do we get loans from that are not conforming to Fannie Mae's lending guidelines? Well, portfolio lenders or conventional lenders, whatever you want to call them. They could be more flexible because they're lending their own money. So I can be flexible I could be the one who decides who I lend my money to. I don't need to conform to some other party's lending guidelines. I am the other party. Right? Borrowers with unusual credit situations, not bad credit, or buying unique houses or large construction projects. They get those loans from portfolio lenders. And those loans that are larger than Fannie Mae's lending guidelines, they're called jumbo loans because they're jumbo in size. So jumbo loans are also non-conforming to Fannie Mae's lending guidelines. They're larger amounts. They're for larger amounts than Fannie Mae is willing to buy. And you would get them from portfolio lenders. Okay. what do we got here? So now we'll do the highlights. Okay, everybody good?
Yes.
All right, continue with your highlighting. We're going to be going over these things now, different types of loan programs, like a purchase money mortgage. If you read it backwards, that's mortgage money to purchase. That's any loan used to buy real estate. And often they refer to seller financing as purchase money mortgages as well. Reverse mortgages are loans to seniors that have a lot of equity in their property. If you're 62 and older, you could actually get a reverse mortgage loan for your house, your primary residence house, not any investment property, just the primary residence. It'll be the only loan on the property because they'll pay off any existing loan that still has an outstanding balance on it. And then they'll slowly pay out the equity back to the homeowner. So it's the reverse of the normal mortgage situation where the borrower makes payments to the lender. With a reverse mortgage, the reverse is true. The lender will make payments to the borrower. And the borrower does not have to pay this loan back unless they sell the house and move or they die. It works as a pretty good retirement plan for those who don't have huge savings. They weren't on some government pension program where they're getting their full salary or next to their full salary for the rest of their lives. It's a good option for people who didn't work in government or for one of these companies that have these retirement or pension plans that they save for. So they could live out their senior years in dignity by having that extra money and not just totally relying on Social Security benefit payments, which ain't that much. Even though it's a lot more than it used to be, it still's not as that much when you can factor in inflation and living in the most expensive state, New Jersey. Home equity loans are a second loan on the house to take out that equity to use on for whatever. And whenever somebody's buying one house before selling their first house, so that they could cover the payments until they're able to sell it, they could get a bridge loan, also known as a swing loan or interim financing, to cover the costs of those making those two mortgage payments till they're able to sell their first house. They're usually interest-only loans, but not always. Sometimes they could be interest-bearing. Typically, they're not meant for more than 6 months, but they can be up to a year. But those ones that are longer will typically charge interest. Or more than interest, I'm sorry. All right. Everybody good or still writing?
Good.
So once again, purchase money mortgage, read it backwards, mortgage money to purchase. So any loan used to buy real estate, and that includes seller financing. The reverse mortgages are loans to seniors that are 62 years of age or older that allows them to tap into the equity in their home without having to repay the money back. Actually, the lender is making small monthly mortgage payments to the borrower. If you had an outstanding loan still on your house, they would have paid it off. And then whatever equity's left, they make those monthly payments to the borrower. The reverse of what's the normal. Now, it's based on the equity in the home. So in order to get a reverse mortgage, the senior has to have a minimum of 60 to 70% equity, the property paid off already. It is a first mortgage loan, not a second loan. You need to know that on the property, because the lender pays off any existing loans. It's going to be the only loan that's on the property. Mortgagee makes small monthly payments to the mortgagor, building up debt. The senior does not have to pay back the loan until they die, until they sell the home or they die. And when the senior dies and sells the home, the lender's paid back all the money from the proceeds of the sale of the property. Plus, so they're paid back any money that they paid out to pay off any existing loan, plus plus all those periodic monthly payments that they were making of the equity. So if the family wants the home, well, they're going to need to pay back the lender in order to keep it. They're going to need to pay back what they paid off on the balance, plus to the senior, plus the interest. So you can get more information from reversemortgage.org, or perhaps one of the actual lenders, aagreverse.com. Here's a couple of commercials from AAG, one of the larger senior lenders that
some people have told me
reverse mortgages. Let me try to raise the volume here a little bit so you could hear it.
mortgages sound too good to be true. I mean, you get cash out of your home, no monthly payments, and still own your home. There's got to be a catch, right, Jesse? Well, there isn't. It's like any other mortgage, only with a reverse mortgage, the loan's paid back when the last borrower leaves the home. In fact, reverse mortgages are based on a notion that President Reagan signed into law over 25 years ago in order to help seniors remain in their homes. They're simply an effective way for folks just like you to get the cash you need to enjoy your retirement.
Call 1-800-791-4075 now to receive a new free information kit, including a reverse mortgage guide and DVD, personal stories from people like you, and a brand new family guide for children and loved ones, all absolutely free with no obligation. With a government-insured, tax-free reverse mortgage from AAG, you always retain complete ownership of your home. Call 1-800-791-4075 to receive your free info kit today.
And then we got another.
If you've been
got a couple of these commercials, they explain a few different things. That's why there's a couple different ones here.
thinking about financial options for your retirement, maybe how to provide some real security for you and your family, you really ought to consider a reverse mortgage with AAG. In uncertain times, it's a safe, effective financial tool. It's already being used by hundreds of thousands of other Americans. It allows you to eliminate monthly mortgage payments, pay some bills, or simply enjoy your retirement more. A government-insured reverse mortgage with AAG allows seniors to stay in their home and turn their equity into tax-free cash. To qualify, there are no credit score requirements, and remember, you continue to retain complete ownership of your home. Hi, I'm Fred Thompson. And if you're like a lot of folks out there lately, then finances might be a little tight. Well, maybe it doesn't have to be that way. Because if you're 62 years or older and own your own home, then join hundreds of thousands of other Americans who have used a reverse mortgage as a safe, effective financial tool. A government-insured reverse mortgage allows seniors to stay in their own home and to turn their equity into tax-free cash without any monthly mortgage payments. You ought to call my friends at AAG. They could help you or your parents right now. And to find out more is absolutely free. Find out how much cash you may qualify for. Call AAG today. Hey, hi, I'm Frank.
Right. Check out. So that guy passed away. Now we got Tom Selleck doing the commercials. And in this commercial here, I got to see if they have one commercial that explains all these things that are a little bit more updated. But this one here from Tom Selleck, I've seen, he addresses some issues that people often bring up too.
I know what you're thinking. I thought what you thought. Some things are just too good to be true. Just like you, I thought that reverse mortgages had to have some kind of catch, just a way for the banks to get your house, right? Well, then I did some homework, and I found out it's not any of that. It's not another way for the bank to get your house, and it's also not too good to be true. A reverse mortgage loan is a simple idea, really. You turn your home's equity into cash, and you pay it back when you leave the house. Most people use the money to pay off their existing mortgage or pay some bills, cover medical costs, even update their home. And, just as importantly, you still own your home. And you make no monthly mortgage payments. It's a loan designed just for older Americans, and it's helped hundreds of thousands to live a more stable, secure retirement and stay in the home they love.
AAG is the leader in reverse mortgages. Call us today for your free information kit. It will answer all your questions and help you decide if a reverse mortgage is right for you and how to qualify.
I know what you're thinking. I did too. I felt the same way. But I checked it out, and I found out a lot more. It's pretty simple. A reverse mortgage from AAG can give you the retirement stability you're looking for. Maybe you want to check it out.
If you're 62 or older and own your own home, give AAG a call to receive your free information kit. You'll receive the information you're looking for, as well as tell you how much cash you may qualify for. Call 1-800-816-7908 today.
AAG, bringing stability to your retirement.
All right, so we have the shared equity mortgage. That's the one where people who it's against their religion to pay interest would get. And they basically partner up with an investor who loans them the money at interest free to buy real estate. And then it's, let me take off this. Interest free to buy real estate. And then they become co-owners on the property. So when the property is sold later at a profit, they share in the proceeds from that sale. Then we have a package mortgage that covers the purchasing of the real estate, but also chattel, like new construction that includes fixtures or appliances that may be on the property, like a washing machine and dryer or refrigerator and things of that nature. It covers the purchase of real estate and the personal property. And then we have a blanket mortgage, which covers more than one parcel or lot. It's used to finance subdivision developments. And these mortgages have a partial release clause in them that allows you to sell off a smaller lot off of the larger one without being required to pay back the entire loan in one shot. And then we have a wraparound mortgage where the seller collects their these loans do not have let me see, it's another loan on a property that does not disturb the underlying financing, or maybe a seller can offer seller financing when they sell their house, even when they have an existing loan on their home. If that loan did not have an alienation clause, a due on sale clause in it, that did not require them to pay off that loan in full, then even a seller who did not pay off their home in full yet and still has a balance, they could offer seller financing to a potential buyer. And this is called a wraparound mortgage. It does not disturb the underlying mortgage. It wraps around it. So This is for existing loan, doesn't have an alienation clause. That's the only time they could offer those wraparound mortgages. Let me know when you got all those highlights.
Got it.
I got it.
Okay. And so basically, here's the slides where I cleaned it up and I just gave the basic definition that's cleaner for each of these loans. If you want to snap a picture, be my guest. For the home equity loan, the bridge loan, the shared equity loans, and the package mortgages, which I just explained. So I'm not going to read through them again. But if you want to snap the picture for the cleaner definitions to study, let me know.
Got it.
Okay. And a bridge loan, when that seller needs to sell their purchase the next home before closing on the sale of their existing one, they could apply for this short-term financing that would allow them to swing the payment in the interim to bridge that gap between the time they bought the home and they sell their existing one. That's why they refer to it as a bridge loan, swing loan, or interim financing. You guys want to snap a picture of this definition, which is clearly a much clearer definition than they give in the book. All right. And blanket mortgage got that partial release clause in there. Allows you to sell off the smaller lot off of a larger one without having to pay back the entire loan at once, but instead you pay off only the smaller portion that's been sold off. So if you have a partial release clause, these blanket mortgages can be used to purchase this whole lot, which is then subdivided into 6 smaller lots. You build a house on it, you sell one off, you only need to pay back 1/6 of the loan, and so on and so forth as you start selling off smaller lots off of the larger one, to give you a little visualization there. So the wraparound mortgage, once again, is the seller offers a loan. So I give a much more detailed information and much more information than the book gives you on this. Wraparound mortgage is when the seller offers a loan to a buyer to finance the purchase of their property, when they still have an existing loan on it that does not have an alienation clause that would require paying off the loan in full. This would allow the seller to transfer the ownership, selling without first paying off that existing loan. The new loan from the seller to the buyer does not disturb the underlying financing. So the seller offers the buyer financing at a higher rate than their current loan, maybe 1%. So the buyer makes mortgage payments to the seller, and the seller continues paying their existing loan. Now, I put in here, it's a good idea for a buyer to enter such agreements, to put a contract in place that would allow them to directly communicate with the seller's lender in the event they stop making the mortgage payments. The buyer could step in and communicate directly with the lender to make them as a safeguard. And then we have an open-ended mortgage. An open-ended mortgage is one that had never closed. So as you pay down the loan, building equity, you could keep drawing on it like a credit card. However, the lender would need to agree to this. Construction loans are typically new loans. Now, I know sometimes they refer to rehab loans as construction loans, but for the purpose of exams, a construction loan is a new loan, and it is a first loan, not a second. So you could get that question correct. So under a construction loan, the lender disperses the loan proceeds while the building is constructed in stages or phases of construction. And so let's say phase one of the construction would require, the foundation be built up to standards and everything up to a certain point. And then we would call the appraiser to come out to the property to confirm that the work had been completed up to that certain point. And then they'll notify the lender to release the funds to the contractor who supplied the work and the materials free up front, knowing that they would get reimbursed by the lender. And then they could start stage two of the construction. That's the way these the financing works on these construction loans. They don't just give you a boatload of money and hope that you do the construction work and buy the materials. They require a builder to supply the labor and the materials up front, and then they get reimbursed in stages. Okay. Any questions for me on any of this stuff, or am I just being that clear that everybody's good with it? All right. Okay, now let's talk about seller-buyer types of arrangements. We have a sale-leaseback. Sale-leaseback is where you're selling the property and then you're going to rent it back from the new owner. This is usually in commercial real estate. In commercial real estate, this is more of a thing where the seller would sell the property instead of taking out a business loan so that they could upgrade their machinery or do an expansion of their business and marketing when they need working capital basically for the business. Instead of getting a new loan, they could just sell their property that's got a lot of equity and arrange to lease it back from the new owner. Now they hold a little bit more leverage here because they don't need to agree to sell the property unless they get good terms that are agreeable to them. Now, this is not only in commercial real estate, though. Sometimes in residential real estate, this is another way, another type of financing method that you could use when you have to purchase your new home before you sell the existing one. You could do well, actually, no, not that type of arrangement. Yeah, when you have to sell your home before you find the new home to purchase, this is a type of an arrangement where the seller can stay in the house a little while longer until they find and close on the sale of their next home. They could arrange to lease it back from the new owner. But this is meant to be temporary, and there's usually escalation clauses in it that it's only for a certain amount of time. And then if the seller stays in there for a longer amount of time, the amount of money they need to pay in that rent becomes greater and greater to try to motivate them to get the hell out. So this could be set up and structured different ways for different reasons, but typically it's used in commercial real estate when additional funds are needed to expand or upgrade operations or machinery, etc. Okay. Everybody got this? Sell leaseback, sometimes used as a means of seller financing. The buyer becomes the lessor and the original owner becomes the lessee. Or another way of saying that is a type of buyer-seller arrangement where the mortgagor becomes the lessee. Ooh. That's also saying the same thing, right? Because the mortgagor is the borrower. It's your property. You're paying mortgage on it, right? And then you're going to become a lessee because you sell the property. Now you're a renter. All right. Now, typical seller financing works just like if you get a loan from a bank, right? You get a loan from a bank, you purchase a property. The loan, the financing is separate from the purchase contract, okay? So you get a loan to buy the real estate. And the lender and the owner gives you the deed to the property. That's your typical seller financing arrangement. Is instead of going to the bank to get a loan, you're going to just be making monthly mortgage payments to the seller. But they give you the deed right away. Now, there's another version of that buyer-seller arrangement called a land contract. But a land contract is also a type of seller financing. It's referred to as an installment sales contract, where the buyer makes monthly installment payments to the seller and they wait for the deed. The seller does not turn over the deed to the buyer until the full amount owed is paid off. Whereas your typical seller financing arrangement, you start making monthly mortgage payments to the seller, but they give you the deed right away. You become the owner of the property and they just essentially become the lender. And if you stop and you default in their payments, they need to foreclose on you to come after you to get the property back. But in a land contract, they never give you the ownership. They never sign the deed over to you until you paid off the full amount owed. It is also a type of seller financing where the buyer's making those installment payments and waiting for the deed. They're not the owner of the property, but they do have a financial interest in it called equitable title, because they've been making those periodic payments that go towards the ownership of the real estate. So they're more than just your typical renter, but they're less than an owner. They don't need to be foreclosed on. If they stop making payments, the owner can get them out a lot easier than having to go through foreclosure. But it's harder to get them out than a typical tenant who's just renting, because they have a financial interest. They've been making payments towards the purchase of the property. So it's called equitable title, that financial interest. Now, don't confuse it with a ground lease, because a ground lease is just the leasing of the ground where then you're constructing a building on it. Okay. Land contract is a type of seller financing where the seller does not turn over the deed to the buyer till they paid off the full amount owed. Everybody clear on that? Any questions on that? Good. Okay, we have a lease option and a lease purchase. A lease option, that's like a lease with an option to buy. And what do we call any contract that has an option in it? I mean, these contracts need to be prepared by attorneys, but they're called unilateral contracts. They're one-sided agreement or promises where one party has an option to do something. And then we have a lease purchase contract where a renter will purchase at an agreed upon purchase price at a predetermined deadline. Whereas the lease option contract, the renter has the option to buy. They're not required to at that but if they do decide they want to buy, it's going to be at a pre-agreed upon purchase price by a pre-agreed upon deadline. So here we could do our highlights. Land contract, also known as a contract for deed or installment contract. And then right there underneath that, type of seller financing. Basically see chapter 11, page 220. That's where we were first introduced to the full definition of it. Okay.
Yep.
Okay. The Truth in Lending Act, or TILA for short, and Regulation Z. Let's see, the federal government regulates lending practices of mortgage lenders through the Truth in Lending Act, the Equal Credit Opportunity Act, and the Real Estate Settlement Procedures Act, and the TILA RESPA Integrated Disclosure Statement, called TRID for short. Remember, I told you President Obama created this new agency called the CFPB, Consumer Financial Protection Bureau, and they took over a lot of the duties and the documents that HUD already created. So in this instance, they took several different forms that HUD had and they integrated them together to create TRID, the TILA RESPA Integrated Disclosure. They combined these documents. Now, Regulation Z, the Truth in Lending Act, is implemented by Regulation Z. It requires full disclosure and truth in advertising when talking about financing in an ad. It does not apply to cash transactions or business or commercial loans. Regulation Z requires that borrowers be fully informed of all the financing charges. Regulation Z's rules do not apply to home equity lines of credit, reverse mortgages, or land loans used with mortgages secured by dwellings that are not attached to the property. So TRID requires the CFPB booklet, the Your Home Loan Toolkit, be supplied to the consumer within 3 business days of the completed loan application. It also requires delivery or mailing of early disclosures about the proposed loan within 3 business days of the completed loan application. Until the disclosure has been made, the lender cannot charge any fees except for a credit report. A loan application is considered complete when the prospective borrower provides the address of the property, the loan amount requested, the income, estimated property value, names of the borrowers and their social security numbers, or aliens. So there must be at least 7 business days between the delivery of the loan estimate and the closing, when they give the CD, the closing disclosure, formerly called the HUD-1 RESPA statement. I already explained to you guys what an APR is, right? The annual percentage rate and how it's different than the regular interest rate that the lenders advertise. The APR is always a smidgen higher because it factors in the costs associated with getting a loan that are non-reoccurring costs, like a loan application or an appraisal fee. These are costs associated with getting the loan, but they're non-reoccurring. But if you were to factor those costs into the life of the loan and then break it down on an annual basis, it would raise the interest rate just a smidgen. Okay. And that's why the APR is always a little bit higher than the interest rate, but it's like the actual interest rate that you end up paying if you were to factor in all those costs, even though the name of it is the annual percentage rate. Under Regulation Z, who is considered a creditor? Well, they define you as a creditor if you issue credit more than 25 times a year, or more than 5 times a year if the transaction involves a dwelling as the security. And the loan must be subject to finance charges payable in more than 4 installments or by a written agreement. Remember, the Truth in Lending Act applies not just to real estate. You could order pots and pans on TV commercials, or cars when they're being sold in those car commercials on TV. You always see in there, according to Regulation Z or Truth in Lending Act, in the fine print that they flash up on the screen for a moment as the speed talker's talking up about the terms. Okay. Anytime anybody offers financing to the public, they need to follow Regulation Z and the Truth in Lending Act. So Regulation Z implements the Truth in Lending Act. It requires lenders to inform the consumers of the true cost of obtaining credit. It allows consumers to compare loan costs of various lenders and avoid the uninformed use of credit. It requires full disclosure and truth in advertising when talking about financing in an ad when certain triggering terms are used. It does not apply to business and commercial loans, cash purchases, HELOCs, reverse mortgages, or land loans secured by movable dwellings. It applies to all kinds of financing to consumers, those buying real estate or a car or pots and pans on TV or a vacuum cleaner or whatever the product is. And here's the breakdown once again of what the APR is and who is considered a creditor. And here's my slide that talks about it all on one page. So if you didn't get it in one of the many other chapters where we discussed it, you may want to try getting the screenshot of this again now. Regulation Z is a federal law. It implements TILA, the Truth in Lending Act. It requires full disclosure when talking about financing in an ad if certain triggering terms are used. Triggering terms are those that would require the full disclosure, and they include if you mention an interest rate, a payment amount, the down payment amount, or a term, the number of payments. This would trigger the full disclosure requirement. So the full disclosure requirement now says you have to use the words in an ad that say to those who qualify or to a qualified buyer. And then you'd have to disclose the APR, the down payment if one was required, and the term, the number of payments. And once again, does not apply to business or commercial loans, cash transaction, reverse mortgages, land loans secured by removable dwellings. Penalties for violating an administrative order of Regulation Z are $10,000 per day that ad is out there in the public domain where people can see it and it's violating the rules. And if you willfully violate it, it's an additional $5,000 fine and up to a year in prison. Okay. So Regulation Z is a 3-day right of rescission for loans used to refinance property that you already own. But there is no similar right of rescission for purchase money mortgages, which are any loan used to buy real estate. And here on page 292, they just give you examples of what the triggering terms are about, which you should already have this highlighted, correct?
Yes.
Correct. Okay, and then it points down to here, which gives you some examples of what those triggering terms would look like. And these are examples of what they would not look like. These would not trigger the full disclosure requirement. But you'd also have to use the terms to a qualified buyer or to those who qualify. And the penalties for violating an administrative order of Regulation Z, which you guys already have highlighted, correct?
Yes.
And then ECOA is the Equal Credit Opportunity Act on the bottom of page 293 there. This had to deal with, ECOA was the slew of laws that were created to protect women in the 70s when they were discriminated against, you know. It requires lenders to notify you when you're rejected for credit of the reason why you were rejected, to make sure it's not for discriminatory purposes. This law was mainly put into place to protect women, even though it has all the protected classes listed in there. It was put into place because women were discriminated against. You know, they go in to try to get a loan to buy a car or a house. You know, they were like, okay, little lady, why don't you go send the husband, bring the husband out, and so the men can talk about the business, make the business decisions, you know. So it was very demeaning. So they put together this law called the Equal Credit Opportunity Act to protect women that are trying to get loans and financing, that they cannot be discriminated in this type of way. So people denied credit must be given a free copy of their credit report and an explanation for the reason of the denial of their credit. And that all comes from this law, ECOA. You know, whether you're denied for a credit card or any kind of credit, it stems from this law. Prohibits discrimination on the basis of any of the protected classes, even though it was primarily created to protect women. And I got a little note here about landlords that may be using screening or grading reports. You know, people may say, well, you're being denied because of your credit, so now you got to issue a letter for the reason of that denial. And some people just avoided this altogether, and they also looked up criminal backgrounds, and they said, okay, well, you're not being denied for that. You're being denied maybe for your criminal background, okay? But now you can't do that either, because criminals are a protected class, or ex-cons are a protected class now under the Fair Chance and Housing Act. So remember that if you're using a tenant screening service, that they also comply with the law as well. And the Real Estate Settlement Procedures Act, RESPA, was enacted to ensure the buyer and seller in residential transactions involving new first mortgage loans have knowledge of all the settlement costs. You need to know that definition. You'll probably see that on exam. It ensures the buyer and seller in real estate transactions have knowledge of where every penny in the transaction goes. It's against federal law for anybody to be paid in a real estate transaction where it was not disclosed that they were getting paid. So the RESPA settlement statement, formerly called the HUD-1, was replaced by the CD, the closing disclosure, because, you know, the CFPB created all these new forms or renamed some of them or merged others, you know. So you need to know what the old form was and what the new document is called and the timelines they need to be given. It explains all the final actual settlement costs to the consumer and must be provided at least 3 days before the closing. So at the beginning of the transaction, an estimate of the closing costs are given, and that's called the LE, the loan estimate, formerly called the GFE, the good faith estimate. This needs to be given to the consumer within 3 business days of the completed loan application at the beginning of the transaction, whereas the CD, replaced the HUD-1, is all the actual settlement cost that's given at 3 days before the closing. You should compare the documents on the LE, the figures in the LE to those in the CD, there's certain loan tolerance limitations that they cannot exceed by. And if they do, then the lender needs to eat those costs. Okay. If you want to snap a picture of this is a pretty good explanation of those documents and when it must be given. But I got other slides too that'll go over these things too. Just let me know if you're going to snap a picture of it or not, so I could go on to the next slide if you're not.
All right.
All right. So here we go. We got that full explanation of RESPA again, and what RESPA law is, and what the purpose of it is. The LE and the timelines that must be given, and the fact that sometimes, look, the LE needs to be given within 3 days of the completed loan application. The CD needs to be given at least 3 days before the closing. But there needs to be at least 7 days between the time the LE is issued and the closing. Now you think, yeah, there's going to be plenty of that because it takes on average, what, 60 days to close? Well, there are instances where the loan estimate, the LE, needs to be reissued when there's certain changes to the loan product or in the loan transaction. So if it's reissued much, much later, there has to be an additional 3-day waiting period added. Okay. So buyers should compare the LE to the CD, and if the costs vary between certain limits as defined by TRID, the lender is responsible for the closing costs. I'm just trying not to read all this stuff over and over again. You know, this is, I already explained this stuff that's on this slide, even though this is a good slide because I got all the cross-reference and page numbers where you could see it referenced in this book. But you have an explanation of what the RESPA settlement statement is. You need to know that for exams. What the loan estimate is, what the document is that it replaced, the timeline that it's given, that it must be given, and that there needs to be at least 7 days between the time of the LE is issued and the closing occurs. And that if it's reissued, there has to be an additional 3-day waiting period added. And the CD's given at least 3 days before the closing. It may be easier just to snap a picture of this slide. Okay, everybody good? So TRID, TILA RESPA Integrated Disclosure, the CFPB merged and modified existing forms HUD created. Lenders are responsible for delivery of these documents in certain time frames. We just learned about the LE and the CD. And lenders are liable if certain costs exceed tolerance limitations. Now, the LE, the loan estimate, that needs to be given within 3 days of when?
After they receive the aliens,
Okay, what is aliens?
address of borrower, the
Well,
loan,
yeah, you don't need to give me all, like the rundown of it all, but what does aliens mean? What is that acronym for?
consent to proceed.
It's when the loan application is considered complete when the borrower provides all the information of aliens. That's what I was fishing for. Okay, so I just want to make sure you guys have an understanding of that, what aliens is. You know, I mean, you're rattling off like what it stands for. That's good that you know that, but it's basically when the loan application is considered complete when the borrower supplies all that information to the consumer. Okay, or when the consumer supplies all that information to the lender. Sorry, and then they could start charging costs for credit checks and things like that, loan application fees, yada yada. All right, so Here, let's highlight on page 294, TRID rules do not apply to the following transactions. We already had this on the previous slides, but and my custom slide, but here we could just put that down. All right. And on page 294, the lender may charge additional fees such as an application fee and appraisal fee only after the consumer indicates an intent to proceed when the loan application is considered complete. The loan application is considered complete when aliens have landed. So when all the information of aliens has been provided, when they provided the address of the property, the loan amount requested, their incomes of all the borrowers, the estimated property value, the names of all the borrowers, and their social security numbers. That's when the aliens have landed and the loan application is considered complete. Okay, everybody got that? So on that same page, beneath that, the loan estimate. Lenders are required to provide the buyer with the LE, the loan estimate, within 3 business days after the completed loan application. Along with the toolkit. Remember the toolkit on how to shop for comparison loans? Write that there, along with the toolkit. Because the toolkit needs to be provided within that same time frame. When I say provided, it means it needs to either be delivered or put in the mail within 3 days. Okay. So page 299, turn a couple pages. Here are situations where a new loan estimate needs to be reissued. When the consumer requests a change, well, actually, you know what? Just highlight this on the next slide. I've got a little bit more to the definition there, and I added a little bit more in there. So let's just highlight this and put a bracket around each section here. These are changes that would trigger a new loan estimate, and these are changes that would not. We're almost done here. I just want to finish this chapter before we break for lunch. Okay, so here are those things, once again, that would trigger an additional 3-day waiting period when a new loan estimate is reissued. If the consumer requests a change in the loan or the amount of their down payment that they're making. If the appraisal came in higher or lower than expected. If there's changes in the borrower's credit score and debts. Here's where I put a tip in here. This is an important tip for you guys. I highly recommend you always go over this with buyers because it comes up often. I'm telling you, it's important for you to know. This is not an exams, but it's an important for you to explain with every buyer you work with. Here, I wrote, buyer's agents should inform their clients not to make any large purchases, charges, buy anything on layaway, do any new car leases or changes in their employment until after the closing, because all of these things could affect their ability to get the loan. Not just trigger a new LE, but they could affect the buyer's ability to even get the loan. The lender could not document the borrower's pay, like overtimes, bonuses, tips, and other income. The cost changed for the services the borrower could not shop for. An interest rate changed because the borrower did not opt for a rate lock or it expired. The consumer can always purchase an extension on the rate lock, though. A prepayment penalty was added. I know. I told you to study. No prepayment penalties allowed in New Jersey. However, from institutional lenders, they're not allowed from institutional lenders. But for private lenders, they can. Usually second loans and commercial loans are from non-institutional lenders, from private lenders. The loan product was changed. That would trigger an additional 3-day waiting period. Or the APR increased beyond allowable limits. That's 1/8 of a point for fixed rate loans or 1/4 point for adjustable rate mortgages. These are all situations that would trigger the new loan estimate being reissued and an additional 3-day waiting period. Okay. So here's again a breakdown. What Aliens is, the LE, the your home loan toolkit, and the CD, and the timelines that these things need to be given in. All right, so let's do this on page 299. Let's write next to LE, loan estimate, what it is. Let's write LE replaces the GFE, good faith estimate, and then do the highlights here. And then right above closing disclosure, CD replaces the HUD-1. Now, the interesting thing is we kept learning about that these documents need to be given within 3 business days of this or that. Well, what is a business day? Well, there's 2 definitions that exist for a business day. One definition of a business day is any day that the lender is open for business. And the other definition is any calendar day except for Sundays and federal legal holidays. Thus, depending on the lender, the creditor, Saturdays might or might not be considered. So there you go, clear as mud. Let me know when you got all the highlights in the notes here.
I got it.
Everybody good?
Yeah.
1 minute.
Okay. Because this is the last slide, I'm basically closing it out. Oh, wait, I may have one more slide there as a little goof there to show you about real estate business.
Yeah. Done.
Yes. So we learned about these rules and I gave you guys some advice. And I found this video that a real estate agent, I think she's from Canada, she put together this cute little video here trying to explain, you know, some of the things that we come across working in the real estate business. And it's a little humorous video, and it deals a bit with some of our struggles, everything from when you're trying to find the address of a property that you need to rush out and meet a client at, and then that you can't find it because it's not in the GPS maps because it's a new address, or the street was never updated in the mapping systems yet. Yeah, that happens. And it is so annoying when you're stressed out, you're in a hurry, you're late, you need to rush and meet a client, and you can't find the address in the GPS because it doesn't exist. But you know that it does. So that could create a little problem for us, right? A little headache. She goes over like the lock boxes, the combo lock boxes and the press button lock boxes, not those super digital ones, but those older style lock boxes. In the winter time, you get a little bit of water in them, they freeze and become icy, and good luck opening the thing without a sledgehammer. You'll see some of the issues she comes across when giving advice to clients and showing properties and them. Well, let's let the video speak for itself. It's a humorous video. I'll chime in every now and then.
Gemma, I've really been thinking about getting into real estate.
Right?
It seems like you've got such a flexible day. You can
Yes.
drive around all the time and make your own schedule.
Right.
It seems like fun and easy.
Gemma, bonjour.
Just wondering, can we see 8 houses tomorrow morning?
Tomorrow morning as on Christmas Day?
The person on the phone, in case you guys didn't hear it, asked to see if they could see 8 houses tomorrow morning. And she's like, tomorrow morning, as in Christmas Day? Yeah, people will not value your time. Trust me.
Okay, I gotta pull up this address. Oh, come on.
Texas frozen shut.
I mean, you get to look at all these amazing houses and everybody's staging right now, right?
Yeah, most of them do. And this is the master bed. I'm sorry, we're not going to see this.
Yes, you will come across that situation where you're showing a house and you're walking in on people doing the nasty. This is why anytime I'm showing houses, I try to get out there and I knock. I don't just ring the doorbell. I'm knocking on the door in case the doorbell don't work. I usually carry a flashlight with me because it also doubles. I carry like one of those police flashlights, the ones with like the 3 triple, the D batteries, the D cell batteries that could also double as a club in case you need to protect yourself for self-defense, So I got a super bright LED flashlight with the 3 D cell batteries in them, a heavy metal type of flashlight. I suggest you guys get one too. It works pretty good in self-defense situations too if you need a club, But I use it to bang on the door and save myself my knuckles to knock on a door. And then as I go into the house and I first enter the house, I'll be yelling throughout the house, realtor, hello, anybody home? Realtor. Even though I set an appointment and I know nobody's there, do it anyway, because I've done this before and there were people home. Even after I'm yelling realtor like that, I walked in a room on people. Well, the wife thought her husband was at work, but he was actually at home in bed with someone else. So I walked in on them. They didn't even notice. So I closed the door and I was like, yeah, we're going to avoid this room. There's somebody in there still. So, and I showed the rest of the house and then we left. It was the craziest thing. But stuff like this happens. Telling you, you're going to come across. Real estate's an adventure.
I mean, you get to work with people. And I love people. I'm a people person.
Gemma, we have some exciting news. We're pregnant.
So we have to stop looking at 2-bedroom houses and we have to start looking at 4.
But we have the same budget though still.
Of course.
All your clients have to do is love the house and then they buy it.
Gemma, this house is perfect.
Right?
Yes, totally. But I feel like there's a but.
But we've only seen 87. I think that we should see some more. It needs to be perfect.
We've only seen 80.
We did it. We found you the perfect house. This house is at market value. Okay, so they're asking $648,000.
So let's offer them $400,000.
Yeah.
Okay, guys, we have received the home inspection report. So everything
Awesome.
is good. We can now remove our conditions.
You said if we find something wrong, we could walk away or negotiate with them, right?
Right? What is wrong?
Well, the lights were too bright.
The paint? Mm-mm.
I didn't like the doorknobs.
It's just the atmosphere.
And the windows were kind of dirty.
It's really messing with my feng shui.
Well, first of all, none of those are reasons to back out of a contract. The only legitimate reasons to back out of the contract are for dangerous conditions. Cosmetic stuff are things that you've seen when you've walked through the house. They're not reasons for you to back out of it now.
I get to see your social media account and all of those happy people. I want to make everybody happy.
Guys, picture! Hey guys, we're happy. We just bought a house. Take a picture. Yay, cheers! Cheers!
So that's fine, but that's not a thing.
What
No, thank you.
You'll see, it'll be great!
No, thank you.
I mean, it's an easy job, and you get paid so well.
Okay guys, so the process is done. So from now on until closing, make sure that you're not buying anything, any big purchases on credit.
Obviously.
Okay, so no boat, no vacation, no cars.
Come on, Gemma, we're not dumb. Gemma, what do you think of our new car?
Isn't it great?
You paid cash, right?
We got a wicked 1.5% rate.
It doesn't matter what the interest rate is. It's going to affect your debt to income ratio. And they may no longer qualify to get that loan to buy the house. This is that note that I told you. You need to discuss this with every one of your clients. Don't go buying things on layaway. Don't be doing any large purchases or leases.
Yes. You know what? Honestly, I think you're going to love it. Would you like me to get you my books?
Sure, yeah.
Yes, do that.
Wait, you have to study all this just to sell houses?
So, I mean, I thought it was a cute little video. You know, it shows real estate. These are real issues that we actually come across. And she made a little goof video about it. I mean, what are you gonna do? This is the business. You're gonna come across this kind of crap. You got to laugh about it. You know, I could write a book about all my instances where I came home. I came to the house. It was my listing, but I also had a buyer I was going to show it to. I set up the appointment with the owner, and she was like, "Yeah, my husband, he should be home." And you know, knocking on the door, ringing the doorbell, knocking on the door. And I call her up again, and she's like, "Yeah, he should be home. He should be home. You should be able to see the house." Because I didn't want to just use the lock box and the key to go in. So I go in because nobody's answering the door. And there he is, sprawled out. As soon as you walk into the living room, you got the couches, and he's sprawled out on the living room with his leg over the back of the couch, totally butt naked. You know, it was like, whoop. I backed my clients out. They were like, "Well, what's the matter? You got the door open." I was like, "I think somebody's home. I think we should knock a little bit more first." You know, I don't think they seen it, but it was a husband and wife and their kids. You know, thank God they didn't see it. You know, but so I continued rapping on the door, and I eventually heard him get up and run out of the room. You know, he said, "Oh, just a minute." You know, thank goodness. You know, I've come across being chased by a deaf dog. You know, you'd figure you knock on the door, you'd hear a bark from a dog or something if they got pets, right? Well, these people had a deaf dog, you know, and I showed a house, beautiful house in Summit, expensive house. They loved it. It was a husband and wife, and they had their newborn baby that the wife was carrying around with her. We showed the whole entire house. The last bedroom we came out of was on the first floor, and then we walked out to the kitchen. They were talking about, what do we do now to make an offer? And then next thing you know, out of that bedroom that we just walked out of, growling, and you know, you got this dog chasing after us. We scattered like a bunch of cockroaches into the closest room possible, and that dog, you know, he was underneath the bed. He came out for a drink of water and got surprised to see us there. You know, he didn't hear us talking. He was deaf. You know, and he saw us and chased after us. So it was like one of those. It wasn't a pit bull, but it was like one of those style dogs, had a really, you know, throaty growl. Yeah, very interesting situations. Come across all kinds of stuff like this in the industry. Anyway, that's the end of this chapter. Let's do the key terms to review, and we could break off for lunch. All right, so there's 2 key terms to review for chapter 15, and Let's start off with key terms to review. 1. Mortgage covering more than one parcel of real estate.
Blanket mortgage.
A blanket mortgage. 1 is A. A mortgage covering both real and personal property. Covers the financing for the purchase of both real and personal property.
Package mortgage.
Package deals. Package mortgage. Yep. 13 is B. Cooperative organization for members who save and borrow.
Credit union.
It's a credit union. 3 is C. A privately owned corporation that sets standards and buys mortgages.
Fannie Mae.
Fannie Mae. 4 is D. Federal Home Loan Mortgage Corporation warehouses packages of mortgages originated by member savings and loans associations.
Freddie Mac.
Yep, if you could just look at the initials, Federal Home Loan Mortgage Corporation, FHLMC. 5 is E. Government National Mortgage Association pools mortgages for investors.
Ginnie Mae.
Ginnie Mae, correct. 6 is F. Additional financing for homeowner, usually a type of second mortgage.
Home equity loan.
Yes, a home equity loan. 7 is G. Loans with interest only, typically for less than 6 months. They're often referred to as when you got to get a short-term loan when you're buying a new home before you close on the sale of your existing one.
Interim financing.
The interim financing. 8 is H, correct. A loan higher than those usually bought by secondary market.
Jumbo loan.
Jumbo, it's jumbo in size. 9 is I. An agent who makes real estate loans, usually for one lender. You may want to write that at the end of that line next to J. Usually for one lender.
That's a mortgage banker.
A mortgage banker. 10 is J. Agent who brings together lender and borrower for a fee.
Mortgage broker.
11 is K, mortgage broker. A mortgage that provides possibility for further borrowing.
Open-end mortgage.
It's open-ended. 12 is L. A straight loan for short-term building period.
Construction loan.
2 is M, as in Michael. Yes. All right, key terms 2. Before we get into them, I guess at the end of letter A, right to buy real estate. To buy real estate. Then next to letter C, where it says seller financing, put slash any loan to buy real estate. Any loan to buy real estate.
What's the previous change?
Next to letter, at the end of the line for letter A, you write to buy real estate.
Yeah.
To buy real estate. Okay. Lending institutions that make mortgage loans to the public to buy real estate.
Primary mortgage.
Primary mortgage market.
2 is A, the primary mortgage market. Loan not intended for resale in the secondary market.
Portfolio loan.
Because they plan on keeping it within their own investment portfolio. 1 is B. Seller financing. Any loan to buy real estate.
Purchase money mortgage.
3 is C, the purchase money mortgage. Arrangement by which a seller becomes a tenant.
Sale leaseback.
The sale leaseback. 7 is D. Process of deciding whether to make a specific loan.
Underwriting.
Underwriting. 11 is E, as in Edward. Words in an ad that require full disclosure of financing conditions. What do we call those words in an ad?
Trigger terms.
Triggering terms. 9 is F. Percentage of income borrowers may spend on housing expense.
Qualifying ratio.
The qualifying ratios. 4 is G. So an example of a qualifying ratio would be a debt to income ratio, for an example. Okay, so 4 was G. A mortgage in which a lender sends regular checks building up debt. The lender sends checks building up debt.
Reverse mortgage.
The reverse of what's normal, correct. The reverse mortgage. 6 is H. A loan in which an investor shares payments and profits.
Wraparound mortgage.
No.
Shared equity.
The shared equity mortgage. 8 is I. Implements the Truth in Lending Act.
Regulation Z.
Regulation Z.
Regulation Z. 5 is J. Regulates consumer loans.
Aliens.
No.
Truth in Lending Act.
The Truth in Lending Act. 10 is K. A larger loan that does not disturb the underlying mortgage.
Wraparound mortgage.
Yeah, it doesn't disturb it because it wraps around it without ever touching it or disturbing it. Yes. So that's a wraparound mortgage. 12 is L. Merges the TILA and RESPA disclosures.
TRID.
TRID. The reason I drank, right? That's what that stands for. 14 is M. TRID. The TILA RESPA integrated disclosure. Detailed loan costs. Where are they covered?
The loan estimate.
In the loan estimate. 15 is N, as in Nancy. Required items before lender can proceed.
Aliens.
Aliens. 13 is O, and that's when a loan application is considered complete. All right, and that concludes chapter 15.